Well, it's a very good morning from me, and it's a very good morning from him. But there we go. I'm Paul Archer. Welcome to my Monday morning live stream, mortgage live stream. Been doing this now for quite a few years, and we'll hope to do so moving forward, because each week, each Monday, we give you an update on all things mortgages, really. So if you're in the mortgage business and you're doing a great job, then we'll keep you up to date with new things, new technologies, new topics, all sorts of things. It's great CPD, really, isn't it? Although it's not legal to do CPD for mortgage advisors, which is a bit tough, isn't it, really? But there we go. If you're doing your CMAPs and your mortgage exams, protection exams and stuff, we'll keep you up to speed as well as we go along. So let's get into our first topic today. I hope you're well, by the way. Hope you've enjoyed the weekend's weather. And we're launching into June next week or week after next. Who'd believe in that? June already? There we go. Isn't the world moving quickly? Now, let's get into a topic which has caused quite a lot of concern with the mortgage trade recently, particularly those people who've joined the mortgage trade in the last 5-10 years, really, since the financial crash in 2008. Most people have tended to join 2016 onwards, really, because things are pretty good in the business, and that's inflation. So I want to talk about inflation. I want to talk about give inflation a chance. It comes from John Lennon's song, Give Peace a Chance. So give inflation a chance. I want to talk to you about that because it's not the be-all and end-all. People think the world's crumbling down, Chicken Lickens falling down and the acorns crumbling on his head. I think that was the kid's story years ago anyway. But it's not a big deal, really. It's not all doom and gloom. So please don't think because inflation's rising, interest rates are going up, and consumer confidence is crumbling, and we're going to go into recession and the whole world's going to come to an end. It doesn't always work like that. So let me explain what I mean by that for you. First of all, the Bank of England have forecast inflation, however you measure it, to be reaching double-digit figures, 10% by the end of the year or early next year. They've said that. And, these guys know what they're doing and they can predict this. So we've got 10% inflation, which we've not had for like years, unprecedented, all that kind of stuff as well. And people think it's the end of the world, but it's not, because what's happening is interest rates are creeping up as well. And when I say creeping up, they're only going to be, they reckon, at about 2% by the end of the year. That's the Bank of England. They're trickling them up by a little 0.25%, tiny little 0.25% here, a little 0.25% there. They're not going up like the big chunks. Back in 1992, I remember I was driving my car as I was working at Black Horse Agencies at the time, and I heard on the radio, remember those things, that interest rates had been increased by 3% in a day. In a day, as Peter Kay would say. And that's the point, you see, because that back then, of course, it was quite horrifying. But now a little 0.25% is not a big deal. So they're trickling upwards, and we'll probably have interest rates at around about the 2% mark, maybe a little bit more. Now, here's the key point here. Interest rates, however you measure it, or inflation, however you measure it, interest rates, the real rate is not 2%. The real rate is -7. Let me explain to you what I mean by that. So let's just head over to little whiteboard I've got over here. Okay, we've got CPI, or however you want to measure inflation. We've got CPI. They reckon about 10% by the end of the year. Bank of England base rate, round about the 2%. We don't know that for certain, do we? So the real rate of interest is actually -8%. In other words, if you were to invest your money at 2%, you would actually lose its value. Your money would come crumbling down. So money in cash is actually no good. And the OECD, the big democracies and economies in the world, the democracies and economic people who like run the world, the big firms, the big countries, they reckon that there's around about, I don't know what these numbers come up, $4 trillion sitting in people's bank accounts. This is not like rich people, like mega rich people. This is just like normal run-of-the-mill people like you and I. There's a lot of money sitting in bank accounts in the US and the UK and Europe, left over from the pandemic when people didn't spend, or they were given money in the US. And this money is sitting there earning sort of 2% or whatever it is. It's losing its value. And that's the point, you see, because borrowing is still relatively cheap, but inflation is quite high. So there's 7 things to talk to you about, really, that makes you think about this not being a major problem. I just want to share some ideas with you. Number one is that people will buy big ticket items. If you buy a big ticket item, the value of that item will come down. In other words, inflation will erode its value. So if you borrowed money and you bought a big ticket item, that big ticket item is going to go up in value because that's what inflation does. I'm not talking about durable stuff that people have to buy again and again and again. They might put that off. But things that are going to be there for them moving forward, big ticket stuff like housing, property, other large items will be good to buy because think about it, the price is going to go up of those big ticket items. So if you buy it now, in 6 months' time, it's going to be worth more. So your value will increase. So people will certainly buy stuff. And houses, property is a large big ticket item, isn't it? The other thing as well is that if you run a business and inflation's quite high, you could get yourself some market share by keeping your costs down, by improving your productivity. You could therefore increase market share. So if you're running a mortgage brokerage, some firm, rather than just put your prices up like everybody else is doing, see if you can cut costs, see if you can get better productivity. And that way you can get a better market share because people won't always follow the companies that put their prices up. So that's another reason that all is not doom and gloom. Number three for you is that people will remortgage. Now, there's an awful lot of fixed rate stuff coming up for renewal, a lot of remortgaging going on. People will remortgage because think about it, property prices have gone up tremendously in the last few years. Therefore, somebody remortgaging after a 3 or 5 year period, they're going to have a better loan to value. So their LTV is going to be much more akin to be getting a better rate of interest if they go somewhere else. So there's a lot of business there for mortgage brokers because people will be doing that on a regular basis. People will exchange cash for assets. That's the other thing to think about. In high inflation, which we've got here, assets go up in price because that's what inflation does. Cash doesn't. Cash sits in the bank, earns 2%, it will go down in value. So this $4 trillion or so of money is going to be used to buy assets, and that'll keep the economy moving along quite nicely. Here's the big one. Inflation, there you go. That's what we're looking at here. Inflation reduces debt. Now, we've never had this for a long, long time yet, but the fact is, if you've got inflation rising along at sort of 10%, every year goes by, your debt goes down in value. In other words, it gets eroded. And after a number of years of inflation, your debt will become like a credit card debt. So if you have a mortgage debt, in 10 years' time, it'll be like a credit card debt because that's what inflation does. It erodes debts as well as everything else. So having a big mortgage is a good thing. So long as you're employed or self-employed, and your salary or your profits rise as well, so you can pay the extra payments you need to make, of course, for the higher interest rates, then you're okay because your debt will come down. Your house will go up in value because they do, because it's an asset, and your debt will come down. And people don't appreciate that. So in high inflation is a good thing, not just for consumers, but also for the government. The government got a massive debt at the moment and they want to get rid of it. It's the best way to get rid of a national debt is to inflationize it. So, inflation might be there for a little while yet as well. Here's a couple of other small ones for you. Banks and our friends, the building societies, will make more of a margin. They'll make more profit because as interest rates go up, they lend at a higher rate. Of course, there's more of a margin going on because they'll keep savers rates low. As they start to make more margin, banks might want to start investing that margin in products, technology that could be competition for you, but it could be good for the mortgage industry as well. And the last one, and this is my big one for you, is number 7. High inflation means that businesses have to innovate, and I'll tell you why. Because businesses, of course, need to maintain their market share, they need to maintain their profits. They can either put their prices up or they can keep their prices keen, which is what the government is encouraging. Keeping your prices keen means that people will flock to you, you'll increase your market share. Just look at the Lidls and the Aldi supermarkets. They're increasing their market shares during this period. So therefore, the way to cut costs is to improve productivity. We talked about that there. But if you can innovate, in other words, use technology to innovate, to improve your productivity, drive down your costs, then you will be a winner. And I think the financial sector that we're in hasn't done this properly yet. We need to, improve productivity, drive up tech investment, and innovate. And I think high inflation will create more innovation, which is makes sense if you think about it. So don't think that inflation is all doom and gloom. It's not. It opens up opportunities for all businesses, particularly people in the mortgage sector. So don't think the world's crumbling down and chicken licking, the sky is falling on his head. I think that was the phrase, isn't it? But as John Lennon once sang in the 70s, give peace a chance, or give inflation a chance. Hope that's been useful. Bye. There you go. Just an update. That's all it was designed to do, because you read about these things and people getting really worried about inflation and a recession and all those things. So let's just keep positive, keep optimistic. Don't be too optimistic, because that way you miss things. That way you can plan forward as well. Let's go to my last topic of my live stream today, and that's continuing from last week when we talked about the 15-minute discovery call. And this time I want to talk to you about the value proposition, the value prop, as we call it. So I got some slides for you. So I'm going to put some slides up for you so you can see where I'm coming with this topic. And because I can, I'm going to join you and come on in, because I can do that. Let's come on in and see you up on that camera there. So let's move across here. Now, from last week, this is our 15-minute mortgage discovery call, which we've talked about before, which is the 15 minutes you do with your client between prospecting and fact-finding and affordability. It's all the opportunities to qualify, to talk about your fee, all sorts of things in the 15-minute discovery call. But one area I want to focus on right now is when you talk about yourself, when you introduce yourself, you want to introduce your value proposition. So what is a value proposition? Well, a value proposition is your opportunity to introduce yourself and what you do and how you work and the value you give to the client. Because you're going to be charging them the fee a little bit later on, telling them about the fee. So you want to be showering them with the value. So what value then do clients want? Well, we've done a huge amount of research over the last couple of years with brokers who are in the virtual world, dealing with the video world with clients and embracing that virtual environment. And the kind of value that you provide your clients goes well beyond getting a best interest rate kind of thing, which has done its rounds for years, but it only ends up in tears, doesn't it? So the kind of value then that we've seen you do, what kind of value do you provide? Well, we've looked at all sorts of areas with brokers, and these are the kind of things that we've come up with. You can read the slides as they come bounding down, but you notice there that you're guiding them along the process. You're sourcing the right loan for them, not the cheapest, but the best loan possible. You're dealing with all the paperwork. You're handling all the different people, all the lawyers and agents and people. You're explaining everything. You're operating on video to suit the customer and to save time. You're holding their hands, answering their questions. You're ensuring they're fully protected, helping you to budget. And you're also using time-saving technology. Now, there's a ton of value there. And that's the kind of value you want to put across to the client when you meet them. But you mustn't just machine gun them with all the value possible. You need to be thinking about what kind of value might suit different types of clients. So then you need to start thinking about what pains they come to you with, or what problems do they come to you with. Because if they haven't come to you or approached your prospecting or your marketing, they would have gone straight to a lender. So they've come to you for a reason. They come to you, a broker, because they probably need you. So what kind of pains then does a typical client have? Again, we've done our research with modern brokers, and these are the sort of things clients come to you with. These are their problems that need solving. Again, you can read that. It's got things like unusual income. They don't know where to start. They're wary of the people in the process. They don't trust people. They feel pressurized, which is awful, really, isn't it? They can't access lenders they need to access because they're not available to them. They've got no time for lengthy interviews, no time to do the paperwork, maybe. They're worried about getting a bad deal. What they call that FOMO, fear of missing out, don't they? Which is quite a key value, isn't it? And they're worried about the costs as well. So these are the reasons why they've come to talk to you. So you need to be able to express your value proposition to maybe handle some of these problems. So let me just give you an idea of the kind of way you can do this. So I'll kind of demonstrate as well for you. First of all, what does a value proposition comprise of? Well, it comprises of 4 things. The first area is you and your role. So my name is Paul Archer. I'm an authorized mortgage and protection advisor. It's perfectly okay. You don't need to go any more than that. And that's you and your role, isn't it? Then you want to talk to them about what you do. Well, I help people to purchase their homes, raise finance from the entire marketplace by scouring the marketplace for the right loan for you. And I take care of everything for you. So that's what I do. Then it comes to how you help. Well, I scour the marketplace for the right mortgage for you, and then I take care of everything. I deal with all the paperwork, I deal with all the people involved. I make sure that you're fully protected in case anything happens to you when you live in the house as well. And I've done this for hundreds of people in the past few years, and I'm hopefully going to be able to do it for you too. It's fine. That's just a bit of value coming in there, isn't it? Then you go on to the next bit, the next steps. Now, this is up to you, of course, but I would always say something like, what I want to do now is explain to you how I'm fully authorized and regulated to do the business with you. But then I want to see more about you and your plans. And that's it. That's the value proposition. It's quite nice, isn't it? It's quite smart. It's quite tailored. Think about it. Let me explain how I'm qualified and authorized to do this. Could well be the next step for you. I think people need to know that you're qualified and authorized because it gives them a good peace of mind, doesn't it? And at that point, of course, let's talk about you. Because you think about it at this stage of the meeting, is that you are in control. You can see from the sat nav there, you know where you're going. You're in control. You're sharing with the customer where you're going with the meeting. They feel quite comfortable, quite warm with you. At this point, then you can start exploring their goals, their aims and objectives as to where they want to go. And this is your chance of 5 minutes just to listen to what their plans are. So that's the value proposition. It's quite neat, quite smart. You need to make it sound good. Obviously, you need all the various disclosure documentation, your IDDs and all those things, and your compliance people will tell you what to do there as well. But don't get too compliancy. Yes, adhere to the rules and regulations, but remember you're talking to a person, a consumer, who doesn't understand some of the technicalities that compliance people use. They need to know what's in it for them, what's the value for them, and that's what we call the value proposition. I hope that's been useful. Alrighty, let's come out of there, shall we? You don't want to see me in the slides anymore. Just a nice little update there for you on some sales skills as well, because we talk a lot to brokers and mortgage advisors about how they can operate their meetings with clients. And we go well beyond just the compliance requirements, which most networks and principals teach you, what you must do and not do throughout the meeting. We talk to you about how you can be more human, how you communicate better with your clients, how they can get a better experience. So if you're looking for some help and guidance on that one, just email me or ping me a LinkedIn message or link in with me as well. It'd be great if you would do that as well. So that brings it to an end. So what's happening down here in Tivoli Studios? Well, we've got a new CMAP cohort starting today, which is interesting. A lot of people worrying about the new syllabus in July. They've held off, enrolling for their CMAPs. But there isn't many changes, by the way, guys. If you're holding off for that reason, you don't need to. There's hardly any changes this year. So that's good as well. Lots of things happening on the advisory side, lots of sales skills we're getting involved in as well, which is always very interesting. And books are being sold and articles are going out. We've got a mailing going out tonight at 6 o'clock to our database. We've got 6,000 or 7,000 people on that at the moment, and we email you with updates every week. So if you're not getting that, make sure you get onto our website and sign up for the database, or ping me a note on YouTube. That's where you find me, and I'll put you on there personally, because I'd love to keep in touch with you along the way. No live stream next week because I'm on my Ollibobs. I'm on holidays, so I won't be doing that. We're going off to Spain for the week, which would be nice. Looking forward to that a lot. Not been abroad for like ever, so we're looking forward to that. Although the plane might be a little bit concerning, but there we are. Got the masks and everything, which should be quite safe. But I won't be live streaming from sunny Spain. I hope you forgive me for that. I'm sure you do. Anyway, enough of that. Have fun this week, everybody, and the following week as well. And I'll be seeing you all very soon. Bye for now.